We are officially kicking off 2026, and January has already set the tone for what could be another interesting year in the P2P space. While the holiday noise is behind us, this month was all about getting capital redeployed, reassessing risk, and seeing how portfolios perform when they are closer to fully invested from the start. In this update, I will walk you through how my portfolio started the year, share January's returns, highlight which platforms are pulling ahead and which are lagging, and revisit some ongoing concerns around risk management and transparency. With most of my capital now actively working, this month gives a much clearer picture of underlying performance. Was January a solid start to 2026, or are there early warning signs investors should pay attention to? Let's break down the numbers, the developments, and the lessons so far. As always, I would love to hear your thoughts in the comments. Let's start with Income Marketplace. My current investment here stands at 7,746 euros, and in January 2026, this position generated 81 euros of interest, which translates to an ROI of roughly 12.6%. All my funds remain fully allocated across available loan originators with no idle cash on the platform. During January, Income Marketplace did not have any major news. The only notable development was a limited time Virtus Lending promotion, offering up to 13% per annum on short duration car loans with early buyback of up to 12 months. Moving on to Lande. My current investment here stands at 1,442 euros, and in January 2026 this position generated 6.98 euros in interest. I managed to withdraw some of the funds that trickled back. Otherwise, nothing special going on. Fintown. My current investment here stands at 8,114 euros, and in January 2026 this position generated 76 euros in interest, translating to an ROI of roughly 11.4%. That puts Fintown solidly in the middle of the pack for this month. Returns here are fairly consistent, driven mainly by real estate-backed loans with predictable repayment schedules. Deployment has been smooth, and I don't currently have meaningful idle cash on the platform, which helps keep the effective yield close to the headline rates. January itself was quiet from platform perspective. There were no major announcements or changes to the business model, and repayment continued as expected. From an operational standpoint, everything looked stable. For now, Fintown remains a steady lower drama contributor to the portfolio. I'm not aggressively adding new capital, but I'm comfortable maintaining my existing exposure as part of the broader diversification strategy. It's not the highest yielding platform I use, but it provides relatively predictable income, which still has value in my P2P portfolio. My EstateGuru investment stands at over 2,600 euros, and in January 2026 didn't generate any meaningful return. This low result is mainly driven by capital tied up in defaulted Germany loans. EstateGuru didn't issue any further updates, and the Germany loans are more or less wiped under the carpet. EstateGuru remains a cautionary tale for existing and new investors. In my case, if I draw a line under what I invested and what I have withdrawn, I currently stand at an about 600 euro loss. My in-rento position now stands at 12,484 euros, generating 108 euros in interest during January, once again with no delays or defaults. Reliability continues to be one of the platform's biggest strengths. The main limitation remains reinvestment friction. New projects still sell out extremely quickly, making it hard to deploy additional capital unless funds are already sitting idle. In January, InRent also released its 2025 annual review, confirming that the last year was its strongest to date, with solid growth, consistent execution, and no deterioration in asset quality. Overall, InRent remains a core, low-stress real estate platform in my portfolio, but one that naturally limits how much capital I can scale without changes to the funding process. My Viainvest position now stands at 18,095 euros, generating 172 euros in interest in January. Once again, steady and predictable with no surprises. January was largely stable, repayments flow as expected, and there were no disruptions or major operational changes. From an income perspective, Viainvest continues to act like an income utility, providing reliable monthly cash flow that complements the rest of my portfolio. Looking at the broader picture, Viainvest's Q4 2025 loan originators report shows that underlying lending operations remained healthy heading into 2026. Portfolio sizes grew in key markets like Latvia and Sweden, with strong loan issuance in Latvia and prudent risk-focused origination in Sweden, while the Czech and Romanian originators also made measurable progress in portfolio build-up and quality metrics. These results reflect continued operational momentum and disciplined credit risk management across the group. Overall, January reinforced my confidence in Viainvest as a core, low-friction income generator, and the broader quarterly performance data adds another layer of reassurance about the platform's long-term fundamentals. My PeerBerry position now stands at €16,079, generating €115 in interest. From an income perspective, PeerBerry continues to be a solid contributor to my monthly cash flow. The auto-invest feature is still not fully efficient, so I regularly step in to manually deploy leftover cash. January brought a key platform update. PeerBerry launched a secondary market, giving investors the ability to sell existing investment. Unfortunately, not all went according to the plan, and the feature is currently disabled. My Esketit position now stands at €7,388, generating €160 in interest during January. Income remains attractive, but my strategy here hasn't changed. I'm still gradually scaling this position down to a level that I'm more comfortable with, mainly due to lingering confidence issues after the platform's poorly communicated operational move to Croatia. The year's end 1% cashback campaign ran into early January, which boosted short-term returns, but I continue to treat these incentives cautiously. Cashback doesn't solve structural or operational concerns. Overall, Esketit continues to deliver strong income, but heading further into 2026, this remains a platform where I'm focusing on risk control over yield, keeping it in reduction mode rather than growth. My Estate position stands at €8,584 and generated €109 in interests in January, keeping it among my highest yielding holdings at over 15% return. Estate continues to share regular visual progress updates via its Telegram group, giving lenders clear insights on construction moving forward. On the platform front, the January performance overview shows a strong start to 2026, with continued community engagement and business growth plans. Overall, Estate remains a high-yield, high-risk and actively evolving platform. January reinforced its appeal for yield seekers who are comfortable monitoring progress and engaging with a more operationally involved investment. My Ventus Energy position stands at over €4,200 and generated €57 in January. Returns remain very high, but this is still a high-risk speculative position. In January, Ventus secured Latvia's first FCR permit for battery storage, hosted a lender update call, and reported continued progress on its solar and BESS projects. Operations are moving forward, but no audit results were published and the mezzanine loan structure keeps downside risk elevated. This stays small, a closely monitored position in my portfolio. Not something I'm adding to, but one that I'm carefully watching going into 2026. My Afranga position stands at €9,650 and generated €92 in interest. Performance remains steady and predictable, with repayments arriving on time and no negative surprises. January was operationally quiet, which is what you want. There were no disruptions, no lender issues, and no changes to how the platform operates. Execution remains consistent as the platform continues to grow gradually. My strategy here hasn't changed. I'm slowly building this position towards roughly a €100 per month income level, without rushing additional capital in. The focus remains on stability and lender quality, not aggressive scaling. Overall, January reinforced Afranga's role as a solid, mid-risk, steady performer in the portfolio. Not flashy, but reliable, which is exactly what I want from this allocation. My Nectaro position stands at over €10,000 and generated over €105 in interest during January. Performance remains strong and consistent, with Credit Prime Romania and Credit Prime Moldova continuing to be the core income drivers. January was operational quiet, with no platform changes or disruptions and repayments arriving as expected. My original goal of reaching around 100 euros per month in interest has now been achieved. From here, any further scaling will depend on continued lender performance and overall portfolio balance rather than active growth targets. Overall, January reinforced Nectaro's role as a stable, low-drama income platform in my portfolio. Not exciting, but dependable, which is exactly what I want going into 2026. January 2026 was a strong and stable start to the year for the portfolio. Total income came in at 1,090 euros, with a weighted average return of 11.2%, confirming that the portfolio continues to deliver reliable monthly cash flow across a broad mix of platforms. Core income platforms like Viainvest, PeerBerry, Nectaro, Afranga, and Inrento all performed as expected, with no payment disruptions and consistent repayments. These platforms once again did the heavy lifting, reinforcing the portfolio's defensive income base. Higher yielding positions such as Estera and Ventus Energy boosted overall returns, but also remain firmly in the active risk management bucket. Strong income is being balanced with controlled exposure, regular interest withdrawals, and close monitoring of platform developments. January didn't bring any negative surprises, and in P2P investing, that's often the most important signal. While reinvesting friction and usability issues persist on some platforms, like for example Inrento, overall portfolio health remains solid, diversification is working as intended, and income remains predictable. In short, January delivered exactly what this portfolio is designed to do: steady income, controlled risk, and no drama, setting a solid foundation for 2026.